The unprecedented opportunity in value stocks. I don't think I need to share with you, or I think I've shared with you time and again that my only holding is VTV, the Vanguard Large Cap Value Index Fund. That's all I got. I got VTV and that's it. And simply because of the reason for the value stocks that historically, and again, you got to be careful, extrapolating future projections with historical data, but there is something to be said about buying stuff that's cheaper now for the benefit of long-term more success than buying stuff that's more expensive. It just inherently makes sense. You buy low and you sell high. Stock investing 101, which means you have to start with the premise of buying low. Now, people say, yeah, but just because it's high now, it can be higher in the future. I get that 100%. But because I'm not picking individual stocks, because historically value has proven that's one of the factors, as value has proven itself time and again historically. And again, we don't know if it will, but it inherently makes sense. If you're buying something cheaper, more likely than not, it will outperform because you're buying it at a discount rather than buying something at a premium. We'll see. But anyway, here's an article I came across yesterday, the unprecedented opportunity in value stocks from Jack Brown. I don't know who Jack Brown is, so let's read who this guy is. I'll share this article with you. Okay, let's see. Hold on a second. Who is old Jack Brown here? Conclusion. He's a partner and chief investment officer at Aviance Capital Partners, a Florida-based RIA, registered investment advisor. Okay. All right, so that's it. It's just an investment guy. All right, so value investing is poised to dominate growth investing based on historical comparison of valuation metrics. I 100% agree. The gulf between the PE ratios, the price to earnings ratios of value growth and growth stocks has never been this wide. At the turn of the century, the aughts, value investing was all the rage. From the peak of the dot-com bubble through 2006, its popularity was supported by academic research and such luminaries as Warren Buffett. Value investing indeed reigns supreme. Since then, from basically 15 years now, its historic performance advantages have vanished. And after the last 13 years of lackluster performance, value investing seems like a relic of the past. We've heard this many times this Sunday. Hold on just a second. Good boy, Pablo. Since 2006, the relative outperformance of growth stocks over value has been strong. In fact, growth has outperformed value by a whopping 140% on a cumulative basis. This is more than a 10% yearly advantage for growth stocks, or 7% compounded annually. Look at that. So value was at 105, is up 100, basically doubled since 2006, while growth is 2.5 times. Look at the Russell 3000 value versus the Russell 3000 growth index. That's crazy, man. I presume that's going to be dividends reinvested. Total return. Okay, good. Look at that, man. That's 2.5 times. Growth has done 2.5 times what value has done. That's nuts. Taking a step back, value investing has historically dominated the broader universe, especially its pricier growth counterpart. The chart below shows the growth of $100 using the French FAMA data, where portfolios are based on companies that fall within earnings yields, earnings to price ranges. The value portfolio represents all stocks with the highest 30% of earnings yields, lowest PE ratios, and the growth portfolio represents all stocks with the lowest 30% of earnings with the highest PE ratio. So again, value, low PE, low price to book, high dividend yield. That's the value. That is what's looked at as value stock. What is low is relative to its peers. All right, it's not low versus there's some number of metrics that says if you have this, your value. If you have that, your growth. It's got to be relative to its peers. So the lowest PE, lowest price to book, highest dividend yield relative to the peers out there. That was what we value today. And value and performance going back to the 1950s, value has gone, was at $100, and value has grown to $1 million. Is that right? Value, wow. Nah, man, that can't be right? Man, look at that. Value, the chart below shows growth of $100 using the FAMA French data, where portfolios are based on companies that fall within earnings to price yields. The value, okay, so they're doing some active trading to just keep in touch with the highest 30% of earnings yields, i.e. the lowest PE ratios, probably every year. So every year they're switching out the lowest PE ratios, or making sure they have the lowest PE ratios, and then they're switching out anything that is not in the 30% range anymore. Look at that. $1 million to value on $100, whereas only roughly $80,000 to growth from 1951. Now, why choose 1951? Why not choose 1940? I don't know. Another metric that's closely associated with the famous French data is the price to book ratio. Here we go. And looking at price to book ratio, the results are quite similar. Price to book data goes back to 1926 and therefore provides an even more robust analysis of that basis. The chart below is the ratio of value to growth based on the two lines above. Value has done, oh my goodness, look at that. Incredibly. Look at that. We're talking 27 to 1 since 1951. Eesh. Got some price to book, price to earnings as well. Value generally outperforms growth on a rolling 5-year basis. And here's our last 15 years or so. So the last 15 years is way under. But historically, going back to I don't know, why is he choosing 56 here? I don't get it. So he's choosing a bunch of different time frames here. I'm not digging that. Why not? You got to be consistent here, brother. So 1956, but you were choosing 1951 before, and then before that, you're even going back to 1921, 26. I don't get that. Anyway, either way, I mean, going back, what's this, 50, 60, 70 years or something like that, there's value outperforming. A couple times growth, value, a couple times growth, value, growth. That's in the late 90s, and then value, and you can see that. Since 2006, my dog over there is going crazy. Value has clearly lagged. This is an unusually long period of underperformance for an approach that has been historically sound. Is it time to give up on value investing? Has a new paradigm been reached that says fast-growing businesses trading at high multiples are relatively better investments? No, I look at fundamentals. A relative valuation on metrics such as PE ratios and price to book between growth and value stocks has changed quite a bit over the recent years. Growth stocks now look expensive to history. Value stocks look reasonably priced to history. Combined, the gap between growth and value stocks is now historically wide on some metrics, such as the PE ratio. Using the data from Fama French, PE ratios can be tracked in 1951. This data can be divided into breakpoints at various PE percentages. All right, I'm not going to read all that stuff, but we're going to talk about growth is here in the blue, PE right there, value is in the green, and here we are, the value. What's this? Let's see here. I'm not sure. Let's take the chart. The gap between PE ratios. Yeah, look at that. That's a pretty significant gap there. So I guess this is PE ratios. Yeah, I'm not sure what this right side is. So this is PE ratios. Value. Let's see. As the chart demonstrates below, the gap between PE ratios for growth versus value has never been as extreme as it is currently. Growth stocks have significantly high PE ratios relative to those for value stocks. We are in outlier territory. Yeah, I'm not quite sure this is the PE, I think, over here, but value is not at 10, so maybe it's the bottom 30% he's looking at. Maybe he's looking at the top 30% on growth and the bottom 30% on value. And if that's the case, the top 30% on growth, does that have a 90 PE? And the bottom 30% on value has around a 10? Here, buddy. All right, let's introduce old Pablo again. There we go. Because he's going crazy back there. Normalized valuations. What would the price impact be if each of these two groups tended towards the long-term median level of the respective group? Growth stocks currently at a PE of 30. Yeah, that's what I was saying. I don't get. Yeah, growth stocks. I don't get what this side is here. Yeah. Growth stocks currently at a PE of 30 trade at a level significantly higher than the median of 20 of its group since 1951. Value stocks, on the other hand, are reasonably priced. So here's historical median 11, current value, that's not a 10. I don't know about that, man. He must be looking at the bottom 30%. So I was looking at Vanguard VTV. I haven't looked at it for a few months. Is that 10 now? If that's at 10, you better be buying value, man. That's all there is to it. And the growth is 32. So what is this right here? I don't get this 90 thing. I'll leave you guys to figure that one out. Simply looking at price adjustment necessary to return to normal levels shows a large 46% advantage for value stocks. Yeah, exactly. So they're saying, look, if we just go back to historical median levels, value stocks will be up 46% relative to growth. I completely agree with that, which is why I'm 100% value. A few observations that may yield some insight as investors decide what to do. Accepting a roughly 46% relative price advantage of value stocks does not make up even half of the great run growth stocks have enjoyed since 2006, relatively speaking. And well, because growth stocks started at a much lower premium at that point. I mean, come on, you're looking at value stocks dominated from 98 or 99 to 2006. Of course, growth stocks are going to have a little bit of an upside relative to that because value stocks are way undervalued. Growth stocks are way undervalued relative to that. So, since growth stocks are more expensive than value stocks and value stocks are cheap, investors may experience more downside in growth stocks. And I completely agree with that. A clear catalyst when dominance switches from growth to value is unknowable. However, value advantage of this extreme, as demonstrated in the previous charts, do not last long. Accepting the above premise leads us to the question, which growth stocks are at risk and which value stocks are poised to grow? And I'll just stop there. That's why I don't care about the individual stocks. All I care about, my friends, is the index for sure. So he's going to give you some information on PE ratios, JP Morgan, AT&T for value, Philip Morris. CVS is interesting. I'm looking at CVS because it's healthcare related. That's interesting to me. But anyway, BB&T. I think BB&T get acquired, or are they merged with SunTrust? Do they take the BB&T name? Probably. All right, anyway, conclusion. I question whether value investing still makes sense. I don't. Over the last several decades, the nature of the markets and the participants has changed dramatically. While value investing, it was a lesser-known methodical investing approach several decades ago, is now simply one of many potential well-known factors. While only a minority of households held stocks up and through the 1980s, a majority of households now own stocks in one way or another. The number of stocks has declined considerably over the past 2 decades. Passive investing through ETFs and mutual funds has become a dominant method of investing. As these changes become more front and center, value investing has underperformed by about 140% since 2006. It's only reasonable to question the benefit of adhering to a potentially antiquated approach to building wealth. All right. Well, I mean, I get you. I get what this guy is saying. I don't question it all, and Pablo doesn't either. So because Pablo says value investing is a way to go, and Pablo's portfolio is all VTV, something you might want to think about. All right, we'll see you guys.